Hello, I'd like to talk to you today about an interesting provision in the Finance Act 2014. I'm recording this talk towards the end of July. The Finance Bill has just become an act. It got royal assent on the 17th of July 2014, and you'll see in the notes which accompany this talk I have updated the statutory references from the Finance Bill to the Finance Act. What I want to talk to you today about is a brand new form of tax relief. It's known as Social Investment Tax Relief, or SITR for short, and it's available for investments in businesses which have social objectives and which trade in a variety of sectors such as employment, healthcare, sport, leisure and so on. I have to say, when I first heard the announcement of these new arrangements in the autumn statement shortly before Christmas last year, it crossed my mind that someone could, for example, put money into their local gym, or perhaps, say, a David Lloyd tennis centre or something of that sort, and get what would appear to be a rather nice series of tax breaks in respect to their investment. As we will see, that opportunity is sadly not available here, because when we talk about businesses with social objectives, we are broadly talking about businesses which, when they make profits, plough that money back to help the local community, rather than allow it to be taken out as remuneration or dividends by the owners of the shares in that company. So, although, as we will see, it operates in a very similar way in many respects to the Enterprise Investment Scheme, the EIS regime, there are, as we'll see, a number of differences. First things first, the legislation, as I've said in the notes, is set out in Section 57 and two schedules, Schedules 11 and 12 of the Finance Act 2014. The new arrangements of SITR kicked in with effect from the 6th of April 2014, and like quite a lot of new tax breaks these days, it is time limited. Under the current regime we have 5 years, but I assume if SITR proves to be the success that Mr Osborne obviously hopes it will be, I wouldn't be surprised to see that 5th of April 2019 deadline disappearing in a year or 2 or 3's time. What are the tax breaks, the tax reliefs that are available? Well, as I say, they are very similar but not exactly identical to those that apply to our clients who make EIS investments. Firstly, let's have a look at the income tax relief. Superficially, this looks virtually identical to EIS relief in the sense that you get an income tax reduction of 30%, up to an annual maximum of £1 million. There is also the same carryback facility that you have under the EIS. The only point, of course, that we would make is clearly anyone who makes an investment in the current tax year, 2014-2015, couldn't utilise the carryback facility because that would involve going back to 13-14 when SITR didn't exist. So the carryback facility will only kick in next year. The interesting point about the income tax relief is that it applies not only to share subscriptions, which of course is the way in which you get your EIS, your Enterprise Investment Scheme relief, but it also applies to the acquisition of a debt investment. In other words, it may well be the case that some clients might be unkeen to subscribe for shares in this or that particular company, but they might be perfectly happy to make loans. It might be, say, a local golf club that needs its facilities upgrading, and the fact that a number of the members could be asked if they would mind lending money, a bit like, I suppose, a sort of debenture, to help improve the facilities, might well be a perfectly attractive way of going about it, given that effectively the amount of your investment will qualify, as I've said, for this 30% income tax relief. But in addition to income tax, there are of course the usual capital gains tax reliefs as well. The capital gains tax reliefs are twofold. The first is a holdover, which as far as I can see is virtually exactly the same as it is for enterprise investment scheme relief. It involves the usual 4-year period. In other words, as far as one is concerned, the investment must take place within a period 1 year before to 3 years after the date on which the gain that you're seeking to hold over arose. The only requirement here is that the disposal giving rise to the gain must be made between the 6th of April 2014 and the 5th of April 2019, both dates inclusive. Obviously, that deferred gain comes into charge with a payment of capital gains tax being due in the event of the social enterprise investment either being got rid of or, presumably, the relevant requirements ceasing to be met. So, that's, I say, there's nothing terribly new there in terms of the concept. Similarly, with the other capital gains tax relief, which is a CGT disposal relief, broadly what this is saying in respect of subscriptions of shares, that any gain you make on the disposal of your social investment shares will be capital gains tax free, provided that, of course, the usual two conditions have been satisfied. The investment must have been held for a minimum 3-year period, and obviously during that 3-year period, or 3-year plus period, your income tax relief mustn't have been clawed back because you've breached one of the key terms and conditions. As I say, as long as those are okay, then when the shares are disposed of, like they are with the enterprise investment scheme, the SITR shares will be capital gains tax free. You will see in your notes I've given you a couple of illustrations of those various points. The first one involves James, who's put £200,000, so well under his £1 million limit, in September 2014 into qualifying SITR shares. That means that he gets an income tax reduction of 30%, i.e. £60,000. Obviously, he would only get full relief if his total income tax liability for 14-15 was £60,000 or more. In this example, I've said, let's assume that James's income tax liability for the current tax year was only £50,000 before any SITR, and so all the claim will do is reduce his income tax liability down to zero, but notice, of course, he won't be able to carry back the unused relief of £10,000 to the previous year, as would normally be possible, because, as I say, 13-14, SITR wasn't around in that year. So that's really the purpose of that first illustration, just to show how the basic income tax mechanism operates. The second example involves a lady called Florence, who later on this year sells some quoted shares and makes a capital gain of £72,000. Now remember, of course, what you're doing is when you're claiming the capital gains tax holdover or deferral relief, as it's sometimes called, you're matching up the gain, not the sale proceeds, you're matching up the gain with your qualifying SITR investment. And as long as, in this case, Florence has made a qualifying SITR investment within 3 years of the 6th of November 2014, when she sold her quoted shares, then in those circumstances she's eligible for the deferral relief. In her case, she makes a qualifying SITR investment of £30,000 on the 31st of October 2016, so well within the 3-year deadline, and that means that of her gain of £72,000, £30,000 can be deferred until such time as her SITR investment is disposed of, but she will of course remain liable for capital gains tax, or would have had to pay capital gains tax on the balance of the chargeable gain, which would have been £42,000 in 14-15. What other key provisions are there in relation to this new SITR social investment tax relief? Well, the first point I might highlight is rather a generous time limit for making your SITR claim. Like most tax breaks these days, very seldom that you don't have to claim them. very few are automatic. In most cases you've got to make a claim. Notice the time limit for this claim. It's within 5 years of the normal filing deadline for the tax year in which your SITR investment was made. That is, of course, a more generous time limit than the usual 22 months or sometimes 4 years that apply in a lot of other cases, and is, of course, in part, I think, to do with the fact that making a successful SITR claim depends on what the company itself does. So that seems to be the rationale for allowing a sort of longer than usual time limit for making the claim. We then come to, I suppose, a slightly odd rule. It's obviously been put in place by the powers that be in Europe. What it says is that to avoid the problems of state aid, that in those circumstances the maximum investment which any one social enterprise can receive in any 3-year period is subject to an overriding cap. You will see from the notes that that overriding cap in the current tax year is an extraordinary figure. €344,000, 827. I might just briefly mention how that is arrived at. It's actually spelled out in the Finance Act 2014, where basically the Finance Act 2014 has taken a figure, a statutory figure of €200,000. What you then have to do is you have to divide it by the aggregate of the capital gains tax percentage that you're presumably saving if you're getting the capital gains tax relief, and the SITR income tax relief. 28% plus 30% is 58%. So if you take 200,000 and multiply it by 100 over 58, that's how 344,827 is arrived at. And at current rates of exchange, I calculate it to be approximately £275,000. So in other words, if I'm a wealthy philanthropist who's minded to put in £1 million, my maximum entitlement this year, into a number of social enterprises, can you see I've got to invest in at least 4, because clearly, even if no one else has invested in any one of the investments that I've gone into, then given that we've got this 3-year cap of in the order of 275,000, you've got to be prepared to spread your money around quite a bit. What types of business, what types of enterprise qualify for SITR? Well, the legislation specifies 4 or 5 qualifying business entities. The first one is a relatively new type of company brought in by the previous Labour government, I think it was in 2005, known as a community interest company, and that's, say, a company which specifically uses its profits and assets for the public benefit. Secondly, community benefit societies, again, which are specifically organisations that have been set up in such a way that when they make profits, they are not allowed to be distributed amongst members or external shareholders, but must instead be returned to the benefit of the local community. In other words, ploughed back into the business. The third category that I've spelled out are, of course, charities and various other bodies that have been approved by the Treasury, as you might expect, given the purpose of this relief. And then finally, something which was added during the passage of the Finance Bill through its parliamentary process. In other words, it wasn't in the original Finance Bill, it's been included since. A type of company known as an accredited social impact contractor. I've given you the relevant statutory references in Income Tax Act 2007 that have been inserted by Finance Act 2014 relating to the necessary requirements for this type of company. So, as I say, if you want to check to see whether a given company would satisfy the constraints of being an accredited social impact contractor, you've basically got to have a look at, I think it's section 257JD of the Income Tax Act 2007. But in addition to investing in the right sort of company, There are, of course, as you might expect from the EIS, the usual raft of conditions that have got to be satisfied in order for the tax relief to be available. First of all, the investor cannot be an employee, a partner, interestingly, a trustee, that might be a concern with some charities, or a paid director of the social enterprise. You can be an unpaid director, as I say, but you can't obviously take any remuneration for the work that you're doing in connection with it. You've also, of course, got the 30% rule. You're not allowed to hold more than 30% of share capital, loan capital, or votes. And, of course, as you might expect, your associates, like your other half or your brothers and sisters, get taken into account in assessing whether you're above or below the 30%. Shares and debt instruments, so if you've made loans, can't carry any right of return which is either fixed or obviously greater than a reasonable commercial rate. And in terms of the overriding pecking order, your investment, whether it's shares or loan, has got to rank at the bottom of the pile. And what is more, if you've made a loan to the social enterprise, you can't have security, you can't have collateral for that loan. It must be an unsecured loan in order for the arrangements to be valid. We then come to what strikes me as an extraordinary rule. I assumed when I first read it in the finance bill some months ago it was a mistake, but I have to tell you that it has not been altered, so that the same rule is now in the Finance Act 2014. It's a provision which is, as far as I can see, identical to the EIS rule, and it says that if you or I are making a social enterprise investment, the organisation that we're putting our money into, the value of its assets must not exceed 15 million before our investment is made, and must not exceed 16 million immediately afterwards. My own view is that that is probably just a drafting error, but if any of you know better, I'd love to hear from you. Of course, when we're talking about companies, the company has got to be unquoted and must be trading on a commercial basis, subject, of course, to that point about any profit being generally ploughed back. Clearly, when we're talking about trading on a commercial basis with a view to the realisation of profits, that rule does not apply to charities in those circumstances. And another interesting provision is that the legislation contains the usual trading exclusions. So in other words, there's a long list of types of trade that your social enterprise company cannot carry on. But again, a lot of these seem to be completely irrelevant for the sort of activities that we're likely to be looking at, because it includes things like banking and money lending. Well, hang on, what on earth has that got to do with the sort of social enterprise investments that we're talking about here? Property development. Can't again readily see that fitting in to the sort of arrangements there. So again, one is left to conclude that the equivalent provisions in the Enterprise Investment Scheme legislation has just simply been copied across into the Finance Act 2014. Again, in line with the fact that the business that your client has invested in mustn't be too large, there is a requirement that says that the number of full-time equivalent employees, to use the current buzz phrase, must not be as many as 500, so you've got to have fewer than 500 full-time equivalent employees at the time when the investment is made if it's to qualify for tax relief. And the legislation also says that there is a 28-month time limit for the company or business using the money for qualifying purposes that has been raised by that investment. And there is a specific requirement that the revenue have got to be notified if the money raised is not appropriately employed within that 28-month time limit. As far as the administrative aspects are concerned, SITR is looked after by the Small Company Enterprise Centre, and it's up to the SCEC, the Small Company Enterprise Centre, in deciding whether a given social enterprise, together with any investments that have been made into it, qualifies for the various tax reliefs. In the notes which accompany this talk, I've given you the details of what is now the SCEC's address and phone number, And as I say, what the SCEC has got to do, it has got to vet the SITR compliance statement, which the company has to complete first and send to the SCEC. And once the SCEC has approved that compliance statement, then it will give authority to the social enterprise, which will allow it to issue what are called compliance certificates to its investors. And it's only when your or my client has received a compliance certificate that they can then actually make a SITR claim. As I said, the rules have ostensibly been in force since the 6th of April 2014, but as is usually the case these days, we were told that no SITR compliance statements could be accepted by the Small Company Enterprise Centre until after the date of Royal Assent. Royal Assent, as I may already have mentioned, was the 17th of July 2014, and so one can now expect the whole business of SITR arrangements to be kick-start and to get in motion. As I said, obviously there are a number of detailed restrictions. You're not investing in a social enterprise to make money. It's broadly a philanthropic type investment. But as I said, I think the interesting angle of this particular new tax relief is the fact that unlike EIS, you don't have to invest in shares. You can get your income tax relief merely by making a loan to the qualifying business. And that, I think, will often be of interest to our clients. Thank you for listening to this talk. My name is Robert Jamieson.